Welcome back, traders and investors, to Benzinga's pre-market prep, brought to you by MarketFi. I'm your co-host Joel Elconin, along with Brianna Valesky, and we have Andrew McDonald on the line. He is CEO of LifeSci Index Partners. Andrew, how you doing this morning?
Great. Thanks for having me on the show.
Okay, we got a lot to talk about in the biotech sector, but could you first start out telling us about your firm?
Sure, absolutely. So LifeSci Index Partners was formed recently as we are launching two biotech-specific ETFs. Our parent firm, LifeSci, has been around for about 5 years, and we've got a team of 6 PhD and MD analysts that analyze the biotech sector, and we provide corporate solutions for companies, biotech companies. We decided that now was the time to launch two biotech-specific ETFs, and that's what LifeSci Index Partners does.
I saw you were at ThinkEquity Partners as well. Did you work with Jack Monopoly over there?
No, I didn't know Jack. I was the co-head of healthcare research and a biotech analyst while there from 2004 to 2006, and prior to that, I was a research scientist with a PhD in organic chemistry and was doing medicinal chemistry myself. So actually spent some time on the bench before going to ThinkEquity.
Okay, so let's talk about that. You're coming from the academic end. Is it? Did you get involved? Were you like heavy into academics, and you said, "Man, with this stuff that I'm studying and learning, I think I can apply to the markets and make money"? Or did you go into this, this sector and getting your PhD, thinking that this is what this was the best way to make a living from your education?
It's a great question. When I finished actually during graduate school, I was very interested in trading biotech stocks and applying the things that I knew about chemistry and medicinal chemistry to analyzing those companies. And then I went off to actually work at Pfizer, a big pharmaceutical company, and then I left to go to a startup company. Both of those places I did oncology drug discovery, but at the same time, for fun, I followed biotech stocks and got more involved with investing in those companies. And after a certain point, I realized that that's really where my interests were gravitating towards, more on the investment side, and really applying the knowledge that I had acquired with respect to doing drug discovery, and applying it towards investing. And so I was fortunate enough to be able to make the transition to working as a sell-side analyst at an investment bank. And then ultimately I moved on to Great Point Partners, which is a dedicated healthcare hedge fund, where I was the biotech analyst. So that's a little bit of the historical perspective on my career.
No, it's just interesting because you took your education, what you were learning, but it sounded like pretty early on you knew what direction you wanted to go. Do you have any good trading? I mean, before you had got all this education, do you have any good or bad trading stories? You said, I don't know if you mentioned when you were in high school or college you were dabbling in the biotechs. Do you have any memorable trades?
Sure, absolutely, I do. I remember back in 2000 when I was working at Pfizer, my biggest position personally was in Gilead Sciences, and I really kicked myself for not just holding on to it. Ironically, fast forward to today, and it's the largest biotech company out there. In particular for Gilead, back in 2000, they were launching their HIV drug, which was the best-in-class drug back then. And you learn the lesson that when a biotech company, is launching a best-in-class drug, you want to own that stock. And flash forward to today with Gilead, 15 years later, they're in the midst of launching their best hepatitis C drug. And so you can look at the data for those products and recognize that they are, in fact, the best products, whether it's HIV or HCV, and you want to own those stocks because they have phenomenal commercial success. Harvoni for Gilead right now is the biggest drug launch of all time. So those are one of the lessons that I learned early on when I maybe sold my Gilead too early. I learned from that lesson, and now that's currently my biggest position. So.
What about, did you get shaken out a couple weeks ago with ABBV getting picked up by Express Scripts for the hepatitis drug and took a little haircut there? Did you stand strong? Maybe don't frown, average down by a little bit more. Or how do you interpret like that? Because it goes from 110 under $90 in a heartbeat. Do you just kind of hold on for dear life?
I actually bought when it was around 100. I had a relatively small position, and then when the Express Scripts news hit, I thought it was an overreaction in the stock. And then when it was down actually in the high 80s, I really backed up the truck. For Gilead, I actually used to cover it when I was at ThinkEquity on the sell side, so I've been following it closely for a long time. Whenever it has a pullback, you want to buy it. And I knew that there was an overreaction here with the Express Scripts news, as there was earlier in 2014 when there was some talk, forget who it was, the senator who was started to talk about pricing controls
Yep.
for the
Yep.
expensive HCV drugs. There was also a pullback in Gilead. I bought some then as well. So, again, the lesson to be learned here is that when a biotech company introduces a truly innovative, best-in-class drug, in this case they are curing Hep C, you want to own that. And there can be a lot of sword rattling with respect to price controls, but that's really all it is, because at the end of the day, very meaningful drugs are going to command high prices, and that's the way it should be.
One thing I noticed when that ABBV, when that news came out, was that they were charging a cheaper price, but it wasn't all that much cheaper. I was like $1,000 or something like that. I mean, Gilead could easily come down and meet that price. So definite overreaction there.
Yeah, and we I mentioned our BioShares. I think for the average investor who's maybe not as in the weeds as I am in terms of looking at these stocks on a daily basis and really analyzing them, I think that's really why we launched the BioShares product. I think what we have done is very innovative in that we've looked at the entire biotech sector stock by stock, and we've categorized each company as either a product-driven company like Gilead, where they've got products on the market, and there's about 35 of those companies now in the biotech sector, which you can think of as more mature because they've already done clinical trials, they've come to the market, they're selling products. So these are revenue and earning stories, and that's the BBP, and that has a very different risk profile, lower beta, as you might imagine, than the basket of companies that are still in clinical trials. They're pre-FDA approval. They're still doing their human experiments to see if their drug works. And as you're probably aware, those stocks have tremendous volatility when they release data. So we created a basket of those companies, the BBC, standing for clinical, the C for clinical, and those are very different profile companies. So I think the biotech universe has matured, and people really need to look at the sector as either product-driven, post-FDA approval versus pre-FDA approval clinical trials. And for people who want to own the sector, but who really don't have the sophistication to analyze individual stocks, this is a great way to get involved in the sector and to own it.
Okay, when we were on the line before we went live, you mentioned that the J.P. Morgan health conference is coming up, and that you were preparing for it because it's very influential in the industry. And Dennis and I have talked about this before. When companies present, I mean, are there people out there, with their iPhones, ready to pull the trigger on stocks or relay the information to trading desks? Is that do you see that going on?
Absolutely, you do. This is one of the most intense times a year for the sector, for the healthcare sector overall. In fact, we've got 50 of our clients, companies in the life sciences, there at a neighboring hotel, and we've set up over 1,500 meetings between our companies and institutional investors. And so you literally have every single institutional investor on the street at the JP Morgan Healthcare Conference doing one-on-one meetings with companies for 4 days straight. It's exhausting, very intense. Companies are putting out important announcements, kind of setting the stage for 2015. So everyone is on their devices, reading the news, making
Wow.
decisions about trades, as well as trying to pay attention when they're in the meetings, learning about the companies that they're meeting with. So it's one of the most intense times of the year and one of the most important times of the year for the sector.
So you'll actually pull the trigger on something, a large holding or initiate a trade on something that goes on at that conference?
Yeah, I think so. A lot of companies pre-announce. They like to leave licensing announcements to the conference, right? So, sort of important corporate developments, licensing, sometimes M&A activities, as well as data releases, guidance, earnings guidance, revenue guidance. All those sorts of important announcements come out, and so people, while meetings generally start at 8 a.m., Pacific time, they're waking up very early to read the press releases and to make
Wow.
decisions. Obviously, the market's open earlier. The conference is held in San Francisco. So, yeah, absolutely. People are making decisions. We actually did an analysis of what happens to the biotech sector between January 1 and the JP Morgan conference, and we noticed that we did an analysis over 10 years that the sector is up several percent just within a few weeks of JP Morgan in anticipation.
Huh, that's interesting. So, does any of your work or your analysis look at the charts of these things? We just had Christian Tharp on, a MarketFi maven and the author of the Five-Star Stock Watch, and he pays attention to all the trials and releases from the FDA, but flat out, some of his trades are based on technical analysis, breakouts and
hmm
breakdowns. You guys pay much attention to
hmm
the charts?
We pay a little bit of attention to the charts, but really with respect to, for example, PE multiples and where the sector is relative to historic valuations. And while the biotech sector over the last 5 years has been up over 30% year over year, it's been a phenomenal, probably even the highest growth sector in the economy. We kind of are asking ourselves, well, look, is the sector overvalued? Is it undervalued? Where do we sit? And the best way of doing that analysis is looking at multiples of earnings and multiples to revenue for the products-driven companies. And then with respect to the clinical trials companies, we look at multiples of cash because these are cash burning companies. So we kind of look at those numbers, where we stand today relative to historical numbers, and really what you will notice is that we're not overvalued. What's really driving the sector, quite honestly, I mentioned Gilead. There's also other companies like Biogen and Amgen, Regeneron, Alexion. These companies are achieving record sales and record earnings. It's lifting the entire sector. So really, when you look at the sector with respect to multiples, we're slightly above the middle of the range, historical range. So I think the sector has a lot of room to grow. And again, what's driving it is the introduction of new innovative products like Harvoni from Gilead, the achievement of record sales. It's lifting the entire sector, and this is a trend that's going to continue. So what I'll say is we look at charts as they relate to historical multiples.
Okay. And boy, oh boy, it seems like over the last week or so, Dennis and I are just talking about one biotech stock or another. It's up some ridiculous amount. Does that make you, a little leery that, things are getting a little frothy in it, or is this something we should just expect to continue into the future?
Well, we have had a bull run, and it is hard to sort of call the top to it. I will say that there have been some companies that are in the BBC, the Clinical Trials Fund, where when they release interesting data, their stocks are up 100%, and you can start saying, "Wow, is that the sign of a top? Are they expensive?" Just because some of these companies are multi-billion-dollar companies and they still don't have products on the market, they're still in the clinical stage. Um, but on the other side, some of them have some very revolutionary technology, some gene therapy technology that has been in research stage for decades. Now is starting to look like it actually works. So these are some technological innovations and revolutions which do occur in the space, and if they're for real this time, then one can argue that those valuations have room to run. So it's really hard to sort of pick them. I mean, I think that's why we love owning the sector, because the sector as a whole over time is going to do very, very well. Some individual stocks, as you know, in biotech are volatile and they have bad results and they're down 50 some percent, and you certainly don't want to be owning that individual stock. I think that's one of the reasons why we launched BioShares, because you can own the sector, you can get the growth, and there will be, when you do have a winner, the winner can be up 10-fold. And so what we've noticed is that over the long run, the winners do outweigh the losers. So whether you're owning the BBP or you're owning the BBC, the sector as a whole is going to do well over a multi-year period. And so while there is a lot of risk to owning individual stocks, particularly when they're in clinical trials and the trial may fail, the sector overall, the basket is going to do well over the long term.
On the line with Andrew McDonald, CEO of LifeSci Index Partners. Two quick questions for you here. The first one is do you use your analysis to short the stocks, short individual issues like you think something's going to turn out bad or there's a overreaction? Do you short these stocks?
I do personally. In fact, when I was a professional biotech analyst at a hedge fund, I had more short positions on than long positions. I think, unfortunately, maybe that's one reason why I'm no longer an analyst at a hedge fund, because when you do have a short go the wrong way in biotech, you can really get it wrong. What I pay a lot of attention to now, personally, is drug launches. I think a lot of times you have expectations for a strong launch of a product. For example, Mankind with their inhaled insulin product. I think a lot of people thought that or think that that's going to do very, very well. Some of the obesity drugs like Vivus and Arena and Orexogen, people thought were going to do well. I worry about those types of launches, particularly when a biotech company is trying to sell into the primary care segment of the market. Those launches typically do poorly. So those would be examples of companies that I like to short on the launch. That's always a pretty good play. And then again, when a company has a truly innovative, life-saving medicine, you want to be long the launch. So
Okay, one quick one
maybe.
for you. I know Dennis is going to want me to ask you about Ova Science. This thing's went from $10 to 50, doing a big secondary at 50. Do you have any take on OVAS?
Yeah, so Ova Sciences, it has been a very strong stock. I don't have as much insight into that one
Okay.
as I'd like, because it's not a pure biotech company. It's not in our BBC. It's
Okay.
really more of a medical products company. so I can't be of help to you
Okay.
there.
No problem. All right, Andrew McDonald, CEO of LifeSci Index Partners. Thank you. Great discussion. We hope to have you on again.
Thanks a lot. Thanks for having me. Bye bye.
Okay.